Choosing the correct mortgage product is quite possibly the most important part of the entire mortgage process, and choosing the wrong one can really set you back in terms of growth and savings. And while we're on the topic of choosing the best mortgage, the option between fixed and variable rate is typically the most common question. Hey guys, how's it going? My name is Jarrett White. I'm a mortgage broker for White Ridge Mortgage here in BC, Canada. If you wouldn't mind, hit that subscribe button, like this video, and ring the bell to be notified when other videos just like this come out. Today, we're going to talk about how to choose the correct mortgage product, not just between variable and fixed, but all the other stuff to consider as well. So I'd say the first thing you need to consider is your risk tolerance. To be honest, so many people were choosing the wrong product in 2022 and 2023, and it costed them a lot of money. This is simply due to the fact that people honestly didn't assess their risk tolerance right up front and just went with what was recommended to them. Now, a general rule of thumb is if you can't sleep at night knowing that your payment might go up, variable is probably not the choice for you. Now, with a variable rate mortgage, if interest rates rise and your payment rises, well, you gotta be able to account for that. Now, if that really does bother you, fixed rate might be the better option. Or maybe you're a first-time home buyer and your budget is just so tight that going over it could be detrimental. Variable rate is probably not the product for you. The biggest issue I saw in 2022 and 2023 is people honestly didn't even know the different types of mortgages, which caused them so many problems down the road. And I'm going to get into those different types later on in the video, but it's so important to know exactly what you're getting into because a variable isn't just a variable, there's actually multiple kinds. And a fixed rate, you also got to consider the downsides like the prepayment penalties that come along with it. That brings me to my next point, which is prepayment penalties. And this is something that gets overlooked way too often. And to be honest, it's probably the most important thing. Every lender and product has a different penalty to get out of it early. And I know you may think that you're never going to break it. But to be honest, most mortgages in Canada don't make it past 3 years. And that's a true stat. There's so many things that people don't think of that cause you to break your mortgage. What if your job gets relocated? What if you separate with your partner? There's simple things just like doing renovations. You need some equity out of the house. The list goes on. But this is something that you really want to account for because this could make or break whether you chose the right product or not. And like I mentioned before, the different lenders offer different penalties on their mortgages. And typically the major banks have the highest penalties when it comes to breaking a fixed rate mortgage. There are other lenders such as monoline lenders that we work with, which are still considered A lenders and have competitive rates. However, their penalty can sometimes be 5 times less than one you would get with a major bank. So let's just run an example. So say you go with a monoline lender, and right now, it may be different by the time you watch this video, but right now you're spending about $10 more per $100,000 you're borrowing to be with a monoline lender. And when I say monoline lender, I mean like First National, MCAP, Equitable. There's so many different lenders that we can access that have great prepayment structures. So let's say $50 more a month with the monoline lender than if you were to go with a major bank. So over 5 years time, that's $600 a year. So 5 years, 3,000 bucks. Now, let's just say that you have to break that 3 years in. Well, you're likely going to see a penalty of about $20,000 with the major bank, opposed to one of about $6,000 with the monoline lender. So that's a $14,000 difference. So yes, you saved $3,000 if you were to last out the whole term, but just the chance of you having to break that mortgage early is going to cost you a lot more in the long run. And the biggest mistake many people make is they think that they're never going to hit this penalty. They think that they're just going to last the whole term. If the market goes down quite a bit and rates are a lot lower, it's very likely that you're going to want to refinance just to have a lower monthly payment and save some money in interest. So that option might not even be available to you if you chose a major bank due to that penalty being so substantial. Keep in mind those numbers with the penalty were just approximate numbers. However, I've seen very similar circumstances with many files that have come across my desk. So the next thing you need to consider is actually knowing the different kinds of mortgages. So you got a fixed rate mortgage, you got your variable rate mortgage, and you actually have another one called an adjustable rate mortgage. And this is where people get it mixed up. People just think it's fixed and variable. That's not true. It's actually fixed, variable, and adjustable. And this is where so many people went wrong in 2021 and 2022. So an adjustable rate mortgage is a variable rate mortgage. However, when interest rates go up, your payment goes up to match that. That means you're going to gradually see this payment increase, so there's no shock and you can actually experience that gradually over time. Now, what this is actually doing is it's ensuring that you're still paying your mortgage down in the same length of time. So your amortization stays exactly the same. Now, if rates go down, same thing, your payment goes down. So you're not paying your mortgage off any faster, you're saving a bit on your monthly payment. And this is what most people think of when they think variable rate mortgage. Now, a true variable rate mortgage actually has a static payment. And what that means is even if interest rates go up, your payment remains exactly the same. And you must be wondering how that's even possible. Well, to make that possible, what's happening is the interest portion of your payment is actually going up, whereas the principal amount of your payment, the amount that goes towards paying off your loan, actually goes down. So the payment remains exactly the same. It's just the makeup of that payment changes. And what that's doing is it's making your payment stay the same, but because your payment's staying the same and your principal payment is going down, your amortization starts extending. This is where you've seen people in 2021, 2022 that have 40, 50, 100-year mortgages. And trust me, no one wants to pay their mortgage for 50 to 100 years. It is not fun. So just by knowing the different types of mortgages, that can really help make that decision. The next important thing to consider when choosing your mortgage is actually working with the right mortgage broker. There is a lot of mortgage brokers out there that send all their business to one bank because that's all they ever know. And they don't actually have the experience working with all the different lenders, even though they do have access to them. So it's important that the broker does have that experience with the other lenders so they know their policies and they know how their prepayment structures work. There are also other features that you're probably going to want to make sure are available, such as being able to port your mortgage, which means move it from one property to a new property without having to break it, or potentially even adding a home equity line of credit down the road because some mortgages don't allow this. So make sure you're working with a broker that can actually explain these details to you and help you decide what is actually important to you. I said talk to a broker and not the bank because like I mentioned, not every bank has every type of product. And when you work with a good broker, we can help determine what is important to you and guide you in the right direction to which lenders you should choose from. Now, the last thing I want to mention is do not rely on forecasts. So this is a huge mistake people made in 2021, 2022 when they're taking variable rate mortgages at 1% or 1.25% because the Bank of Canada said we are going to keep interest rates low until the end of 2023. Very, very low. Now, considering we just lived through all that, that was the furthest thing from the truth. So just because they say rates might come down, don't rely on that when choosing your mortgage. Always account for the worst case scenario. And in the event of 2021, 2022, the worst case scenario was actually rates going up 5%, whereas a lot of people thought the worst case scenario was rates going up about 1%. When I say forecast, I mean also don't rely on past data too much as well. See, the reason why a lot of mortgage brokers were recommending variable rate mortgages to their clients in 2021, 2022 is because, believe it or not, a variable rate mortgage statistically over history, basically all of history, has always beat out a fixed rate mortgage. By the end of the 5 years, you typically always save more money with a variable rate mortgage versus a fixed rate mortgage. So most brokers were actually confident in the product and happy to recommend it to their clients, but that's because they were basing their decision off of past data. I don't know about you, but I don't think there's a single argument to be made that variable beat fixed the last couple of years because the people that chose fixed rates, they're still in 1.97% rates, whereas the people that chose variable, they're all the way up at 6%. Now, the only possible way that the variable could still beat out the fixed rate is if you were to break your mortgage early because the variable rate mortgage does have a substantially lower prepayment penalty. However, even in that case, I think the savings is so far apart that the savings made already would account for that payment. Now, if you're in need of a mortgage, we are more than happy to help at White Ridge Mortgage. Our goal is really just to make sure you can make an informed decision. So if you're interested in having a conversation, I will put a link in the description. Click that link, fill out the form, and it'll allow you to choose a time that works best for you to have a quick chat. And if you haven't already, please hit that like button, subscribe to this channel, and ring the bell to be notified when other videos just like this come out. It would really mean a lot, and it does help videos just like this get in front of more people just like yourself. Thanks a lot for watching, guys. Catch you on the next one.